Hi there, and welcome. I'm RV, and this time we will be taking a closer look at the balance sheet. In particular, what a balance sheet is, its component parts, and how you can use the information it provides to make better decisions for your business. Okay, let's get started. So firstly, what exactly is a balance sheet? The balance sheet is one of the three primary reports used to get an understanding of the financial position of a business. The other two are the income statement, or profit and loss, and the cash flow statement. We'll look at the last two in other videos, but this time we will focus on the balance sheet. The balance sheet gives us a snapshot in time of what the business owns and what it owes. These are always equal, hence the name balance sheet. The things the business owns are its assets, and what the business owes is comprised of things it owes to third parties. These are its liabilities, and what it owes to the owners of the business. This is called equity. Now we know what a balance sheet is. Let's have a closer look at the component parts, starting with the assets of the business. These are broken down into three types. The current assets are things that are, or can be converted quickly to, cash. Examples are cash in the business's bank account, inventory or stock that can be readily sold, amounts owed to the business by customers, and prepayments made to suppliers. Next, we have the fixed assets, sometimes known as non-current assets. This would include physical things like computer equipment and machinery, as well as any land or buildings the business owns. Thirdly, are the intangible assets, meaning things you can't actually touch but that still have a value, such as intellectual property, goodwill in a brand, or licenses the business holds. Now let's look at the things the business owes, its liabilities. This time we have two types. The current liabilities, so things like amounts owed to suppliers, taxes the business is due to pay, and accrued expenses. And non-current liabilities, like long-term loans. The last thing to look at is the equity. This is generally made up of two elements. First, we have funds introduced by the owners, such as share capital, and then retained earnings, i.e., net profits from previous periods. Putting all of this together, we can see the structure of a balance sheet. A typical cloud accounting balance sheet will look something like this, but it will differ slightly because the look and format will vary, depending on the accounting standards in your territory, the specifics of your business, and of course the styling of the software you are using. But looking at this example, it's clearly labeled as a balance sheet at the top, with the name of the company marked II. And there is a date, so we know when this particular snapshot of what the company owns and what it owes is from. Below this are the sections we looked at in more detail earlier, namely, assets, liabilities and equity, each with line items particular to the business, subtotals and then totals, representing our balance equation. Assets equals liabilities plus equity. Finally, let's explore some ways the balance sheet can help inform better decisions. Firstly, you can use it to assess the financial health of your business, as it provides answers to questions like, can you meet your long-term debts? Can you pay your bills on time? And how strong is your overall financial position? The balance sheet can be used to help identify financial risks. Is your business relying too much on debt? Do you have enough cash to cover day-to-day expenses? Are you holding too much or too little inventory? It can help you make investment decisions, like how should you finance your business, debt or equity? Or where should you invest your resources? It offers help evaluating business performance. Are you making money? Are you using your resources wisely? Are your investments paying off? It can provide key information to support loan applications, to show lenders you're a good risk, or even identify assets you can use to secure loans. Then, there are the insights it can provide when making strategic decisions, such as, can you afford to grow your business? Or should you enter new markets or offer new products? By understanding these metrics and the relationships between them, you can make more informed decisions that drive your business forward. So, take a closer look at your balance sheet and start making the most of this valuable financial tool. For more tips on how cloud accounting can benefit your business, check out our other videos, like these. Click on the logo to subscribe, or use the email link to get in touch about your specific business. Thanks for watching.